Today, we're going to tackle a big question a lot of beginner investors have. What's the difference between index funds and mutual funds? Now, they sound similar and both are tools to help diversify your portfolio. But while one can help you save thousands in fees over time, the other might be quietly eating into your returns. So let's break this down in a way that's clear, simple, and gives you the power to make smarter investing decisions. So let's start with mutual funds. A mutual fund is like a basket of investments, stocks, bonds, or both, managed by a professional. You and thousands of other investors pool your money together, and the fund manager decides what to buy and sell. Now, it sounds great, right? Well, here's the catch. That professional manager needs to get paid, and those fees are called expense ratios, which can range from 0.5 to 2% annually. So here's an example. If you invest $10,000 in a mutual fund with a 1% annual fee, you're paying $100 per year, even if the fund doesn't perform well. Now let's talk about index funds. An index fund is also a basket of investments, but instead of trying to beat the market, it just matches the market. For example, an index fund that tracks the S&P 500 simply buys shares of the 500 largest US companies. No guesswork, no stock picking, just passive investing. And because there's no expensive manager making daily decisions, fees are much lower. Some index funds charge as little as 0.03%. Let me give you a quick comparison to show you how much fees can eat into your investment over time. Imagine you invest $10,000 for 10 years. If you put that into a mutual fund that charges a 1% annual fee, you'd end up with around $9,050 after fees. But if you put that same $10,000 into a low-cost index fund with just a 0.03% fee, you'd keep closer to $9,970. Now, the difference might not seem huge right away, but over time, especially with larger investments, it really adds up. All right, let's break this down and compare index funds and mutual funds side by side. And I'm going to make it very nice and simple. So index funds are what we call passive investments. They don't try to beat the market, they just track it. So if the S&P 500 goes up, your index fund goes up with it. They also come with very low fees, often under 0.1%. That means more of your money stays invested and working for you. Another benefit? They're tax efficient because there's less buying and selling going on inside the fund, and you're hit with fewer capital gains taxes. And finally, index funds are perfect for the long-term, hands-off investor. You can set it and forget it and let time do the work. Now, mutual funds are a little different. These are actively managed, which means there's a fund manager trying to beat the market by picking and choosing stocks. So because of that, they come with higher fees, usually between 0.5 and 2%, which can chip away at your returns. They also tend to generate more taxable events because there's a lot more trading going on behind the scenes. And here's the kicker. Most of them don't even beat the market. In fact, studies show that over 85% of actively managed mutual funds underperform the very index they're trying to beat over a 10-year period. So which one should you choose? Well, it all comes down to your goals. If you want simplicity, low fees, and a solid long-term performance, index funds are your best bet. But if you believe in a specific fund manager, or you want someone actively adjusting the fund based on market trends, you may lean towards a mutual fund. Here's the truth. Passive investing through index funds has helped millions build wealth quietly and consistently. And while mutual funds still have their place, especially in older portfolios, more and more smart investors are shifting to low-cost index funds for the long run. So remember, investing doesn't have to be complicated. It just has to be consistent. If you found this video helpful, do me a favor and like the video and subscribe to this channel for more smart money tips. And if you're looking to get started on your investing journey, tap the first link in the description of this video. But with all that being said, my name is Amner Gellin Jr., and as always, stay smart.